So with the enormous trend towards self-managed super funds, a lot of trustees might have ignored the importance of insurance, which comes automatically with retail and industry funds. But now the government wants self-managed super fund trustees to think about it. For more, I'm joined by Sinclair Taylor, Head of Self-Managed Super Fund Trustee Distribution with Westpac. How are you, mate?
Good, thanks, Peter. How are you going?
Excellent, excellent. So let's talk about insurance, because a lot of people escape from retail or industry funds because they want to manage it themselves. Could be a good decision, could be a bad decision.
Escape, I like it.
Yeah.
I like it.
Well, when they do it, I think that the reason is that they think they can do it better. They sometimes find they're not, and I believe there's a lot of drifting back. But what a lot of people forget about is that when you're in those retail industry funds, you do get insurance. And so a lot of self-managed super fund trustees didn't have insurance. Is that right?
Well, look, the Cooper Review into Australia's superannuation system looked at this issue last year. And what the Cooper Review found was that less than 13% of self-managed super funds carry insurance inside the fund. So that's not to say they're underinsured, but it certainly suggests that not many funds, and remembering this year we will pass 500,000 self-managed super funds in this country, not many of them actually carry insurance. And as you say, members are rolling out of other superannuation environments where this stuff comes by default. So it's certainly worth thinking about.
And do you think, I don't know if you guys have ever done any qualitative research, but do you think a lot of people just haven't thought about it, that they're focused on getting great investment returns and they just forgot that they basically could, and maybe should, we'll debate that later, have that inside the self-managed super fund?
I think that's a possibility. I think in the focus to set up a fund, there is a fair bit of paperwork involved, and it's a big decision. And one thing which we're really clear on is self-managed super is not right for everyone. It suits a certain type of investor who wants to take a very hands-on approach. But in setting it up, there's certainly a possibility that people leave that insurance component to the last minute. It's also a possibility that people are leaving insurance in place inside those other superannuation environments.
Yeah, I suppose some people might say, look, I've got $1 million in my super fund, but I'll leave 20,000 in there and transfer the rest in the self-managed super fund, and the premiums will be eaten away, but still I've got the coverage.
Look, and that's a very valid strategy, and this is where it's really important to get good advice, to really consider what type of insurances do you need in a personal context, and then also with inside superannuation. But that group buying power, often associated with those large APRA funds, is certainly attractive.
Yeah, and that's the point. Those big funds can have much better buying power when it comes to insurance, and therefore the premiums are really low compared to if you try and put it inside the self-managed super funds yourself. I guess it's going to be an area that insurance companies will start chasing, that because there's a potential need there. If the price is the barrier, they might start thinking about creating better products for SMSF trustees?
Look, that's certainly a possibility. I don't believe that price is the issue. Remembering, of course, that inside superannuation, generally speaking, insurance is tax deductible. So you're paying for it in an environment which is quite tax effective. You know, arguably it's cheaper than paying for it out of your own pocket outside of superannuation. So accessing those tax benefits are one of the reasons people like insurance inside funds. But I think what's important to note here is it's about getting the right types of cover and making sure you've got the right
What do you mean by that? You're obviously
insurance.
making a point when you say the right type of cover. Can you give me an example of someone who might have the wrong kind of cover?
Well, it's worth considering how can you access the insurance benefits when you need to access them. So the commonly held policies inside superannuation are term life and total and permanent disability insurance. So term life and TPD are often packaged up together. That's a really useful bundle of insurance
It's a sensible one
products.
that to at least has a minimum.
So trauma cover, for example, is not recommended, and people don't hold that inside SMSF or inside superannuation. Yet income protection is also possible. So getting good advice around what type of personal insurances should you hold is really important, and also considering it for all of the fund members.
That's a really good point, because the stuff you get inside a typical super fund is a one cut fits all. But in actual fact, you may well have some very special requirements, particularly if you are running a business, and you working in that business might be critical to the whole operation of both the business and the super fund.
That's right, and the other thing that is worth considering around insurance, if you've got assets invested inside the fund, like a property, they're very lumpy assets, they might take up a very large share of the total fund balance. Insurance is a very useful tool to help provide some liquidity if something does happen to one of the members. So if you're reliant on paying ongoing benefits, that insurance might be a very useful mechanism to
and I guess you need insurance.
top up the cash.
And you also need insurance for those properties as well.
That's right. So the general cover is also worth remembering. With the review, though, from Cooper, he basically suggested that it is sensible that the government enact legislation to require trustees to consider this as part of their investment strategy.
So it sounds
and that's now what's happened.
It sounds like a softly, we want you to do it, but we're not going to make you. Is that right?
I think that is right. And look, this is all very prudent.
Yeah.
So Cooper is not suggesting that SMSFs don't have enough insurance, so it's not necessarily an under-insurance issue. It's just an issue that is of such significance that you are now required, as part of your investment strategy, to actually document what you've done with your insurance options. Have you taken it out? Have you made a note to yourself saying, I've got enough cover? And once again, the government's not making you take out insurance. They've just shoehorned it in as the 5th item you must now consider in your investment strategy.
If you don't, could you be penalised?
Well, this is absolutely, it's a compliance issue now.
Yeah.
So
it's like investment strategy. Have you got an investment strategy?
That's right. So every SMSF trustee has to have a written investment strategy. That document has to cover things like risk and diversification, solvency, liquidity, and now the 5th item that has to cover is this insurance issue. So your funds auditor will be looking at that document on an annual basis, checking that you're actually investing in accordance with that strategy.
Yeah, and I guess if it's a family self-managed super fund, your requirements for insurance could be different to your 20 and 30-year-old sons.
That's right, that's right. So the need for insurance really is life stage driven. You need to think about what sort of ongoing family obligations have you got. If you've got debt inside a self-managed super fund, it's really critical to think about potentially using insurance to extinguish that debt. So the remaining fund members, in the event of a death, aren't saddled with that burden.
I made the point earlier in the interview that I've seen some evidence that self-managed super funds are growing at a rate of knots, but there has been a little bit like coming back. People have tried it and they found it a little bit challenging. Have you guys at the bank actually noticed any of that kind of thing happening?
Look, we're seeing very consistent growth inside SMSF. Last year, the recent ATO stats suggest that 40,000 funds were set up last year. One of the largest years. 2007 was the largest year, and there were 45,000 funds set up. And that was really associated with the very large cap and the desire for people to put $1 million into superannuation as a one-off contribution.
Yeah, that's right. Yeah.
We also lose 2, 3, 4, 5,000 funds per annum. So people do close funds, often for very good reasons, and some people aren't in the right environment, and they should go back and consider other APRA style funds. So it is not right for everyone, but people seemingly are very happy with their choice to get into an SMSF, and we've got a net growth figure of about 35,000 funds every year. Yeah,
and obviously as a bank, and all your rivals are doing the same, you're really positioning yourself to actually change the kind of products you sell to people. Because once upon a time, when people went to self-managed super funds, they went to a financial institution and took out super funds and whatever. This is a new game for you guys as well, isn't it?
Look, the game has changed. Australia's superannuation environment has now changed. We've got 31% of Australia's superannuation assets sitting inside SMSF, circa $480 billion. So it is the largest slice of Australia's superannuation pie. We're certainly very interested in it, and we're not alone, because more and more Australians are opting for this style of environment to invest within, and we want to obviously meet their needs.
And we're also seeing a shift out of the safety of term deposits back into the equity markets. Are you guys seeing that?
Oh, look, the cash component is still very strong. There's around $135 billion in cash inside SMSF. Arguably too much cash, and obviously the banks are very happy to take it. But as equities pick up, I'm sure many trustees will revisit their investment strategy, and once again, that's what they're required to do, to reallocate potentially into other asset classes.
The interesting thing is that a lot of self-managed super fund people were criticised before the GFC for not taking risks and being in cash. And often the argument was they're so busy in their small business, they said, the accountants put me in it, just leave the money in cash. It ended up being a pretty good strategy for about 3 or 4 years, wasn't it?
Anecdotally, there is an element of dumb luck involved in having cash in the last couple of years. But suffice to say, that's not a long-term investment strategy.
No, definitely not.
And one thing which is very interesting that we see, and is certainly borne out by some of the broad ATO statistics, the smaller the fund, the greater the propensity to cash, and also the more narrowed view around asset classes. And that potentially is a risk for trustees who aren't considering diversification.
And that's why people need education.
They do, and good advice.
Yeah, without a doubt. Mate, thanks for joining us on the program.
Thanks, Peter.